Let's bring in Tobias Lefkovich, Chief US Equity Strategist at Citi. Tobias, good to see you as always. Down, 10% from the recent highs, as I said, about 0.6% today, the energy sector. Are you constructive on it here?
Kind of more neutral on it. Well, there are elements that make it really interesting in terms of valuation, things like that. The problem with energy to a certain degree is that it's been a poor return on equity player for years. It's not a phenomenon that just developed in the last 6 months. And what happens with oil prices when they go up is that there's a supply response. In other words, rig count starts moving up as well. I think energy is down not specifically due to its own fundamentals. I think in general, value stocks, which include energy, industrials, materials, have all kind of traded off with bond yields pulling back as people worry about what the economic implications of those pullbacks in yields are, although a lot of that still has to reflect certain technicals in the bond market.
How important is the dollar on the direction of this sector and the underlying commodities?
So dollar is really important for commodities in general. We could be talking about precious metals. We could be talking about energy. We could be talking about copper, which isn't necessarily a precious metal, although the price makes it a little more precious today. But historically, the dollar has been an important dynamic. And what's really interesting is that oil prices have outpaced energy stocks year to date in terms of the performance. And usually the energy stocks tend to be a better read than the oil price. So we've seen this before where the energy stocks have not reflected the crude price move. And as a result, people have said, ooh, the stocks are cheap. And what ends up happening is the oil price is kind of back in. So people are thinking about what happens with OPEC and production increases, thinking about what might happen with negotiations with the Iranian regime in terms of potentially having them join the market again. So that's still kind of an overhang on the market on oil. Our energy guys think oil prices could go up a bit, but probably pull back next year anyway.
Yeah, so just to dig into that a little bit more, Tobias, materials tend to be, and I know you just kind of touched on this, but materials tend to be in some of the other industrial, whether it's commodities or even certain, stock names, tend to move in tandem with oil because the broader effects that move oil also affect them as well. So I wonder whether you think oil or energy is the only sector to be looking at here, given the conversation we're having, or whether there's other opportunities elsewhere as well.
So that's a good question, Maureen. We tend to steer a little bit away from materials in the U.S. because it's 80% chemicals in terms of the weight. Only about 15% would be metals and mining, and being much more tied to kind of the traditional commodity demand story, or oil price, or rather dollar prices movement that we were just talking about. I think industrials are probably a little bit more interesting, particularly capital goods producers, as we're seeing strong ISM data, as we're seeing good durable goods orders data. Those all send a very positive message for industrial activity. Last week, we got the senior loan officer survey from the Federal Reserve Board showing almost record easing of credit conditions for businesses, which means you tend to see increases in capital spending, increases in industrial production. In that sense, those capital goods producers could be some of the real beneficiaries. The only area, for example, even like in tech right now is tech hardware, and that's partially because of that capital spending opportunity.